Close this. All right. So before we get started, for some of you guys who just joined, go ahead and start thinking of some of the questions you want asked by the end of this session. That way we can make sure you guys are actually grasping everything that we're going to be talking about. Some of you guys may have either joined the last class, Stock Options 101 Part 1, or have watched the recording of that Stock Options 101 Part 1. So in that session, we did focus on the basics, right? As far as what is an options contract, what are different types of ways you can trade an options contract, the different types of option contracts, and all the factors that go into play whenever you're dealing with options, because it is a little bit more or a lot more complex than just trading stocks. We got somebody else. All right. All right. So, and again, this one is definitely going to be more question driven, where the slides are going to be a little bit more. We're going to have less things on the slides, but we're going to focus on different topics and subtopics until everybody fully grasps everything. So, there will be some points throughout the session where I will ask some of you guys to unmute and ask your questions verbally as opposed to writing it in the chat. And hopefully that works pretty well. But whenever you are not asking a question, please make sure to mute your mic. That way we can make sure everybody can hear clearly. Let's just go ahead and hop into it. All right, today's list of topics. All right, one, in the money versus out of the money. All right, we're going to talk about what that means, why it's important to understand that as you're getting into advanced options trading, and the different advantages and disadvantages either side of it allows you. Number two is going to be covered calls. Covered calls aren't as common in my experience than buying calls. Excuse me, but we'll talk about that so we can help round out, your guys' strategies and be a little bit more versatile in this crazy volatile market. You definitely want to know of different ways to profit. Number three, we're going to talk about leaps. Hey, what's up, Vienna? Number three, we're going to talk about leaps. A lot of you guys, if you've been with Oasis for a while, you should be pretty familiar with leaps and how we typically trade them and why we typically trade them and some of the advantages and disadvantages they have as opposed to other types of options. And then number four is just going to be the Q&A. But again, there will sort of be there will be a lot of opportunities to ask questions throughout the session. But to round up these three topics, we want to go into a fourth one that's a more formal Q&A, just to make sure you guys are actually grasping some of the topics. Even though this is being recorded and will be available on for all of our high rollers. If we can get those questions out during today's session, I believe that would be ideal. So, all right, so we're just gonna jump right into it. All right, so topic number one: should I buy in the money or out of the money options? And before I even get into this, I want to offer one of you guys an opportunity and share what you know about the difference between in the money options versus out of the money options. And these topics on the screen are just here to somewhat facilitate that discussion and make sure we're covering all of our bases. But there may be other things we'll add on to this slide. So let's see. Who would like to go ahead and take this first question? And again, it is just telling us what you know about the difference between in the money and out of the money options, etc. All right. Who we got? Who we got? Go ahead and unmute your mic. Yeah, I can hear you. Who's this? All right, what's up, Ian? Thanks for volunteering. Okay, got you. Okay, and in your experience, what were some of the times you chose to use one over the other? Okay, your portfolio. All right. Okay, so that's pretty good. That's a pretty good explanation. Anybody have anything else to add on to that before we go to the next one? And thanks again, Ian. I appreciate it. Going once, going twice. All right, so we're just going into it. All right. So if you have been following some of my trades, now granted, I haven't been trading much lately due to my work life balance or lack thereof lately. But if you've been following some of my trades, you will see. And actually, can go to some of them. You will see how I tend to trade a variety of options. Sometimes they're in the money, sometimes they're out of the money. All right, so we'll go to Ask options. So this one was a lotto. You see, it was well out of the money. And then we had a few for Boeing. We have a few for Caterpillar. But something you will notice is that a lot of times when I'm going out of the money, I'm sorry, when I'm going in the money, my positions are usually larger than they are when I'm going out of the money. And a lot of that pertains to the level of risk, although right time is going to come into factor, at all times. A lot of that deals with level of risk, and something else we're going to talk about shortly is called intrinsic value, and how that relates to your risk and how that affects your profit, right? Because whenever we're trading, we're kind of balancing that risk of losing money versus the opportunity of making money, right? And depending on what type of play you're looking for, it's going to be different variations of risk and reward. So, but that is one of the things I do want to harp on at first. Is usually when I'm going larger in a position, I'm typically going to buy in the money, and we'll talk about why that is. All right, so let's see. Kind of put up some notes here. So one of the first things we want to explain is intrinsic value versus extrinsic value. Right. So if you've seen the last video that we did, we talked about the different components of what makes up your premium, right? And just for some of the people who weren't here, may not be tracking. Well, I understand this is the advanced level, but we might have some people where they haven't really gone through the basics. Let's see if I can pull up the slides from that from our last session. Options, basics. Just bear with me. Okay, here we are. So we talked about what's an option, etc., etc., etc. And then we way down here. And then we talked about the basics of premium, right? So one of the things we talked about was price, right? And how the price of the underlying stock is often a factor that makes up the majority of an options premium, right? Because options allow you to control a large amount of stock, specifically 100 shares per standard contract. The price of the underlying stock has a big impact on the options price, right? And then we talked about delta. This is the Greek responsible for measuring the amount of an options contract's value appreciates or depreciates for every dollar the underlying stock increases or decreases, right? So main thing you want to take from this part is that the underlying stock's price and how it relates to your options contract price is a big factor in how much your options contract is worth at any given time, right? Because one of the things we also talked about is how the value of an options contract at any given time, it fluctuates. And one of the factors that largely determines how much it fluctuates is the movement of the underlying price of the price. Not sure why this thing just popped up. Sorry guys, I am new to Zoom. So another basic of component of premium is time. We talked about time. The value of an options premium changes as its time to expiration decreases, and the rate of this change increases as the expiration date nears, right? And then we talked about the Greek responsible for measuring the daily rate at which an options contract's value depreciates or appreciates due to time decay, right? So another big component of premium is time, right? In 1 second, we're going to revisit a few of these principles. Third one, basics of premium, is implied volatility. Implied volatility refers to the amount of an option's premium attributed to a stock's perceived riskiness. To put it another way, it estimates how much price movement is expected by the market in that stock before expiration. A stock that's more likely to make a big move in price up or down has more implied volatility, and a stock that's less likely to make a big move has less implied volatility. Right? Higher implied volatility equals higher premium. We think of really volatile stocks in the past like GME, AMC. When they became very volatile, that had a very significant effect on the price of option premiums. They were through the roof. Just buying an options contract that expired 3 days out was costing a few $1,000s in the money and out of the money. So, but one of the differences we want to talk about real quickly as it pertains to stock options part 2, all right, is the difference between intrinsic value and extrinsic value, right? So to give you an example, and we'll talk about price here. Let's say you have a options contract, right? Let's just pull up this. Let's say you have let's pick a random stock, like, let's just go with Amazon. All right, what's the price of Amazon right now? Let's see. All right, so Amazon right now is trading for $3,052. All right, so let's pull up my notes again. All right, so Amazon is trading for, we're just gonna say $3,000 just to make it easy. Yeah? So Amazon is selling for about $3,000. All right, and we're gonna make it very simple. We're not even gonna talk about expiration dates or anything right now. Let's just say we have a options contract. It's a call option, right? Let's say we own a call option, right? That has a strike price of, let's say, $2,500. So what does that mean, right? So a little recap. What does it mean if we're saying we own a call option that has a strike of $2,500? Well, what that means is that for every option that we own, every call option that we own, we have the right to buy 100 shares of Amazon for what price? The price of $2,500, right? Now, first thing you notice is that, hey, Amazon right now is selling for $3,000. So if you own the right to buy Amazon for $2,500, your contract has intrinsic value, right? And going back to what we were talking about before, one of the major Greeks that are responsible for movement and the valuations of options contract is its relation to price, right? The delta, right? So when you see that, give you an example, and now we're going to throw in expiration date, right? Let's say that the expiration date is later on this week, which is the 21st, 22nd, 23rd, 24th, 25th. All right, let's say the expiration date is the 25th of February. All right, so let's say that our options contract that gives us the right to buy 100 shares of Amazon at the price of $2,500, even though the price is currently $3,000 per share. All right, let's say that options contract expired this upcoming Friday, right? And in the scenario, let's say that on Friday, by close of business, right, Amazon is selling for around what it's selling for right now. So let's say, how's it going, Jason? All right, so yeah, let's say in the scenario, Amazon is still selling for about $3,000 by the end of the day, Friday, and we still own this call options contract that gives us the right to buy 100 shares of Amazon at $2,500. At the close of business, if we just sat on that options contract that gives us the right to buy, right, what will be the value of our options contract, right? And that's a big question because, right, it being in the money from the go. Let's say you bought it in the money from the go. You were buying something that already had intrinsic value. Hold on, somebody is on chat. Oh, awesome. Somebody's answering the question. Yeah, right. So what does that mean? In a sense, it means it's less risky in a sense, right? Because let's say instead of buying that in the money, you bought something that was out of the money, right? One of the things you're gonna notice is that it's gonna be a little bit more volatile, right? Depending on the underlying stocks movement. But another thing that you're gonna have to understand is that at expiration date, if that contract is out of the money, that contract is worthless, right? Therefore, as time um, as time gets closer to the expiration date and it's still out of the money, you notice that it's the value of that options contract is going to go down way more drastically for every little movement, as opposed to if you had a options contract that you originally bought in the money, right? So it's a little bit it's easier to. So here's the one thing: they're going to typically be more expensive, right? Because they have intrinsic value. However, depending on how you use it, it can be a little less risky, right? When things are slightly a little less risky, of course, that affects the profits. But if we can put in a scenario, you can kind of see how this works. All right, so let's go to Amazon. All right, so right now it's selling for about $3,000, and let's look for a options contract. All right, so again, if you weren't here for part one, whenever you're trying to buy an options contract on any platform, you want to look for the options chain. When it comes to Thinkorswim, you want to go to trade. First thing you're going to do is find your expiration date. All right, so let's pick the 25th of February. Right, and the first thing we want to do is let's try something that's out of the money. All right. Let's see how far out of the money we're gonna go. Let's try something like 3,100. Why not? So right now these are selling for about 3,600. So we're gonna throw this into our risk profile. Gonna delete this old stuff. Okay, so one of the options we're going to put in here is out of the money. And then we want to grab an in the money contract. So let's find one. I know we were talking about one that was 2,500. It's deep, deep in the money. But why not? Wow, that's deep, deep in the money. Oh, passed it. Wow, so right off the back, you're going to see it's a large difference in price. All right, the out of money you see is cost about oh, see, the out of money one costs about $3,700, whereas the in the money one, this deep in the money, costs about um, over $50,000. So just to be fair, let's find something that's like way out of the money a little bit more, something like 900. All right, cool. All right, so let's say you're playing with a large sum of money, right? And you understand that, you know, your position moving 1% here, 2% here, 3% here is a equates to a large gain, all right? Whereas if you're only putting in $1,000, 1% here, 2% here is really not as substantial, right? And let's say you wanted to go large, right? So you can take advantage of those profits, but still not risk the house. Well, let's say you went so far in the money that you have a $2,500 call option in Amazon, right? And you think that Amazon is going to go up about 5% between now and Friday, right? So what I'm going to do is just single out that one and reset my price slices. And then go 5%. I'm going to change my expiration date for the scenario to the 25th of February. All right. So again, you put in about $55,000 because you thought Amazon was going to go up 5% over the course of a week. Um, what would your profits be on Friday? Well, if you look here, you would see that your profits would be a little less than $13,000. Right? Now, let's see how that value changes throughout the week. Let's see that Amazon started off the week hot and it hit that 5% target by, let's say it hit it by Tuesday. Excuse me. Well, you would see it would already be slightly more than it would be if it was on the 25th. And it's not a real large difference between what it would be on that day and the 25th. All right, now, all right, let's do the other side of that, and let's say that on the 25th, Amazon was down 5%. Right. Well, what you'll see is that your options contract would still have value because in that scenario, Amazon would be trading for about $2,800, and your options contract had a strike price of $2,500. So your options contract would still have value. However, it would be less than what the value is originally, right? You would, in a sense, lose about $17,000, right? So if we were to do percentage rise, just roughly, we're talking about 55, 40-minute time limit. I didn't know that was a thing. Thanks, soon. So 55,000. What is the percentage of $12,700? So on the profit side, like we were saying, that would be about a 23% gain, whereas on the loss side of things, that would be about a 30% loss, right? All right, so now let's look at what things would be if we had this one. So we got the 25th, all right? So let's say we bought, instead of buying the in the money option, we bought the out of money option for about 32, with a strike price of 3,200, right? That means that at the close of business on Friday, if the underlying stock, right, is not above our strike price to an extent, then it will expire worthless. Well, if you're looking at the profit and you're seeing that there's profit here and you're confused, why does it have profit? Well, that's because on these price slices for this risk profile, essentially showing you different scenarios. When you go to a date, it's actually showing you the value of that option contract at the beginning of that day, right? Because you'll see if we go to the next day, then you'll see it would be 100% loss, right? Because this price slice, if it went 5%, it would still be under $3,200. So just something to keep in mind, all right? Now let's say that Amazon went up 5% on the 22nd, right? At the beginning of the day, it was about it was almost at $3,200. Well, on this day, on the 22nd, your options contract would have 1, 2, 3 days left to expiration, right? And on this 22nd, right, your options contract that has the strike of $3,200, right, the underlying stock is just slightly below that with 3 days to expiration, right? So although in this scenario your out of money contract is still out of the money and it has no extra intrinsic value, since it's so close to being in the money and has time on it, right? Because time is going to be your extrinsic value. That extrinsic value is that much higher. So it makes up for that lack of intrinsic value because it's already almost in the money, right? However, for every day you get closer, let's see, go to the 23rd, right? Now you see it's about $600-700 less, and then we go up a day, right? It's about another $500 lower, and then we get to that the day of that morning. Now it's at about 100% profit, but throughout that day, if it doesn't go above, you lose all of your money. So at expiration date, you're out of the money contract for as long as it's out of the money has zero intrinsic value. And since it's already past expiration date, it now has zero extrinsic value. All right. So I hope that kind of helps you guys understand the concept of intrinsic value and extrinsic value. In a nutshell, when you buy an in the money call option, you're buying something that already has intrinsic value. So that means once it loses every bit of extrinsic value, that is, once time to expiration date is zero, your contract still has some value, right? So that does mean that, all right, the profit potential is slightly less than out of the monies in certain situations where underlying stocks shoot through the roof. But what it also means is that when you want to go larger, when you want to put in a larger position, which you essentially have to because in the money contracts are typically more expensive, um, things are a little bit more predictable, right? You feel a little, it's a little less risky, but it still has some risk there, which is a little less risky because you know that if all things go to hell, your contract still has some intrinsic value. And some things that you'll notice is that so recently we'll pull up. Let me pull up the news because this is pretty interesting. And give you an example of how people make a lot of money buying in the money call options. So I'm actually using Google Call. So what was government officials. Oh goodness. I guess because I'm using my VPN. All right. So just recently, 2 days ago, it was announced that the Fed approves rules that will ban officials from trading stocks, bonds, and also cryptocurrencies. Right. So if you're not familiar with the background behind this, you might be like, all right, who cares? Well, for those that have been around, you have heard um, a lot of chatter about Nancy Pelosi's trading. Nancy Pelosi has made a lot of money trading stocks, and a lot of people believe that it's unethical because, of course, these officials have a lot of inside knowledge as to the big sweeping changes the government is working on making, um, and therefore they're able to get into these huge in the money options positions and profit from this insider knowledge that they have that may be a few months, maybe 4 or 5 months ahead of the actual positive uh, catalyst events, that they're pretty much front loading, right? So as you see, Pelosi opens the door to stock trading. Now I'll tell you back in what year was it? It had to have been 2020. Yes, it was the end of 2020, right? Tesla, we can actually pull this up. Uh, I'm going to tell you about the in the money call options that Nancy Pelosi bought. Uh, okay, so we're looking at, let's go to 2020. All right, so right here, this is August 2020, and then this is around November and December. So as you see, between October and January, Tesla went from 385 to about 886, right? So what happened around that time? Well, Tesla announced their stock split. They had they're also having there are also a lot of rumors regarding their no, actually it wasn't rumors. At this point, that's when they were added to the S&P 500 around the same time. It was like December 21st of 2020, right? And then Tesla continued just shooting through the roof. And then around sometime in January, it was announced because the officials they have to report this stuff after the fact, right? It was announced around this time after Tesla had already just shot through the roof that Nancy Pelosi had made upwards of $10 million from deep, deep, deep in the money options contracts that she had bought before this spike, right? So she was one of the big people that kicked off this resentment towards trading officials. But really, why I'm bringing up this scenario is, all right, if she's putting all this money, a few $1 million into this stock option position, pay attention as to what type of options she bought. Right? She didn't buy out the money. Let's say she knew it was gonna skyrocket above $800 a share. She could have bought stock options for $800 a share back when Tesla was only selling for about 400, right? She could have bought something that's a little less out of the money, like $600 call options, if she knew it was going to go that high, right? However, she bought deep, deep, deep in the money. I can't remember how deep it was, but I remember it's very significantly deep. Let's see if we can, and then we'll talk about why that is. So Nancy Pelosi, deep in the money, Tesla options. Oh yeah, her husband is like a big Wall Street guy as well. Oh, here we go. Oh, that's Wall Street best. I don't want that. Oh, look at this. House Speaker Nancy Pelosi placed up to $1 million worth of bullish bets on Tesla stock. Right, purchased 25 call options on Tesla with a strike price of $500. These call options are set to expire March 18th, 2022. Right. House Speaker Nancy placed up to $1 million. Yada yada yada. Okay, it doesn't say when she bought it. Speaker by the right to buy shares. Each time. Apple stock. Okay, we won't waste too much time here. But I remember when this happened. So if you're putting a lot of money in, like we are talking about, a lot of people tend to buy in the money, right? That way, in the event things do not go as planned, as the stock market, usually puts you into these situations, um, your money still has value, right? So let's see where we left off. Okay. All right. So that long explanation was regarding intrinsic and extrinsic value. Does anybody have any questions as far as like the difference between intrinsic and extrinsic value and why it's important to understand this difference and how that pertains to whether or not you're going to buy in the money or out of the money options? Any questions? Going once, going twice. Okay. What's your question? Yes. Mm-hmm. Exactly. Yes. They're usually cheaper. They're usually cheaper because they don't have intrinsic value. Um, they're usually cheaper, and we can actually pull them up. So look at Tesla right here. Oh, oh, oh. Tesla right here selling for a little under $900, right? And right now we're looking at the 25 February expiration. If you look, and these are strike prices, right? All right, you see as we go out of the money, it gets cheaper and cheaper down here. right? Because what are the odds of Tesla stock shooting from less than $900 to $1,100 in 5 days? The odds are low. Therefore, the sellers of these calls are not going to charge you as much because it's not as risky for them. Whereas the deeper you go in the money, these premiums, they get more and more expensive. And that's because these strike prices are already well below Tesla's current price. So all of these options contracts, they have real intrinsic value because they're already, if you were to exercise these options, you would have profit, depending on how much you pay for the premium. Does that make sense as far as like in the money and out of money? I'm sorry, I didn't catch who that was. For the guy that just asked the question, you can go ahead and unmute your mic. I just want to make sure that you've caught that concept before we move on. Going once, going twice. Okay, awesome. So before you mute back, um, intrinsic versus extrinsic. If you buy something in the money, does it have intrinsic value? Okay, exactly. Yeah, so if you look here, these are the calls, and if you look on the right side, these are the puts. Yep, yep. And the strike price is down here. Yes, this is Thinkorswim. Ah, gotcha. Yeah, yeah. So it's gonna be somewhat similar. Okay. Any other questions before we move on from intrinsic to extrinsic value from anyone? Okay. Because that's the main thing you guys want to get a grasp of when you're deciding whether or not you want to buy in the money, out of money. Um, that decision is gonna weigh heavily on whether or not you want more intrinsic value than extrinsic value. Your in the money calls, right? Things that you're buying that are already in the money, they have an intrinsic and extrinsic value. Whereas your out of money calls only have extrinsic value, right? Typically cheaper, right? So one of the things we did not talk about, okay, is that let's say, I think we were talking about Amazon. One of the things we didn't talk about is depending on the movement of the stock, uh, you can make significantly more money if you have out of the money calls. It's more risky, right? But typically, the more risky stocks, stock trades, stock options trades, on the other side of that is typically more reward. The possibility of more reward. So if we go back to the risk profile, well, right off the back, we did see that the gains here for in the money versus out of money were higher, right? So now we have it a little above the strike price. The current price on the 26th, and you'll see that for this out of the money call that we originally bought for $1,000, the profit would be almost $4,000. Right? That means your $1,000 contract that you bought originally would be worth about $5,000. Right? So that's obviously a higher percentage gain than if we're going to switch back to in the money, than if you held that in the money contract to the 26 with the 7% gain on the underlying stock. You see the profit would be more dollar wise, $18,000, but percentage wise, um, the fact that you put $55,000 in that call options, you making $18,000 is significantly less of a percentage gain than had you um, bought this out of the money contract down here. In fact, if we can, let's see, $18,000 divided by about $55,000. So that's about 32% gain, right? And that would be a heck of a lot of money if you had like $1 million worth of, deep in the money calls like Nancy Pelosi did with Tesla, right? And then we'll go to the out of money call. 1,000. Hold on, let's see how much profit it was again. 1,000 divided by, let's go, 36. 1,000. Oh, sorry, I did it wrong. So the profit would be 3,600 divided by. Okay, so that would be about 360% gain. So if you put $55,000 into that out of money contract, you're talking about upwards of $160,000 in profit, right? So, and then it gets even more drastic if, let's say, Amazon goes up something crazy like 20%, right? If you have the in the money calls, you would be a little over 100%, right? Because you put $55,000, and now you're looking at $61,000 in profit, right? So a little over 100%, a lot of money. But then you compare it to what you would have if you had the out of money contracts, and you'll see the profit is significantly more, right? Because you would have only put in $1,000, and you would be profiting about $46,000, right? So that means if you put in $55,000 into this out of the money contract, right, that would be, well, let's see, about 46 times. Yeah, you'd be a millionaire. All right. Okay, so I think we addressed that one. Okay, so that's intrinsic versus extrinsic value. All right, and I think in talking and discussing that, we did go over risk versus profit, and I believe we did go over position sizing, right? Um, we did not go over. We did go over number of days expiration, but I don't think we touched on the buyer being a buyer versus being a seller, right? So we'll briefly go over that because that is going to be an important thing to grasp as we prepare for our next session, which we'll be talking about debit call spreads, etc. So a lot of times when we're talking about trading options, we talk about buying options, more specifically buying call options, right? We don't often talk about selling call options, right? So whenever we'll go back to, let's go back here to trade. So whenever you're considering buying an option, right, no matter what strike price it is, there's always someone else on the other side of that transaction, right? And whether or not that person could be, someone else like you that's deciding to sell the call that you're trying to buy, or it could be, like a market maker that's just trying to, create a market. In order to create a market, somebody has to be on the other side selling the things that you want to buy, right? So, um, in the money versus out of money is going to affect their profits as well, right? Now, we won't go too deep into the selling of calls because that's going to be our next topic. We're going to talk about covered calls. But before we move on to that, it is important to understand that um, there are more ways to interact with calls and puts. You can buy, but you can also sell, right? Now, it typically flips the effects of different Greeks, right? So it does get a little bit more complex, and that's talking about, all right, where with Delta, we're buying calls. Typically, underlying stock goes up, right? Delta is going to measure how much your options contract goes up, right? But if you're on the other side of that, you know, things like delta and theta can flip where it'll increase versus decrease, etc. We'll get into it in this next topic, but just kind of want to touch base on that one before we move on to our next topic. So covered calls, and now we get into all of that, right? So what are covered calls, right? Before we go into covered calls, I want to give you guys somebody an opportunity to share what they know about covered calls. If there's anybody that already has a grasp on this concept. All right. Anybody want to give this one a shot? Going once, going twice. Anybody want to give this one a shot and share what their knowledge is on covered calls? If nobody's familiar with them, I'll just go into the instruction. Going once, going twice. Okay. All right. So we'll just go into it. One second. Slideshow. All right. Cover calls. Okay. So what are cover calls? So first, let's give you guys like the textbook definition. Like if you were to look into Google, let's see what kind of definition it gives you. All right. What is a cover call? All right, so Investopedia, great resource. The term cover call refers to a financial transaction in which an investor selling call options owns an equivalent amount of the underlying security. To execute this, an investor who holds a long position in an asset then writes/sells call options on that same asset to generate an income stream. The investor's long position in the asset is the cover because it means the seller can deliver the shares if the buyer of the call option chooses to exercise. Right? A cover call is a popular option strategy used to generate income in the form of options premiums. Investors only expect a minor increase or decrease in the underlying stock price for the life of the option when they execute a cover call. To execute a cover call, an investor holding a long position in an asset then writes/sells call options on that same asset. Cover calls are often employed by those who intend to hold the underlying stock for a long time but do not expect an appreciable price increase in the near term. The strategies are ideal for investors who believe the underlying price will not move much over the near term. Okay, so a lot to unpack there, all right? But in layman's terms, right? So imagine you own 100 shares of a stock, right? You own 100 shares of the stock, and your intention is to hold 100 shares of these stocks, of this stock, for a very, very, very long time, right? And let's say that although you think it's going to go up a tremendous amount, during the long term, let's say that over the next few weeks, you don't think it'll go up much, right? In fact, let's say it might even be a slight chance of it taking a dip in the short term, right? Now, whenever you're in a long-term position and you're looking to hold it, but you foresee some potentially volatile weeks, days, or months ahead, you have a few options. You can either hedge or you can, yeah, no problem. You can either hedge or you can sell cover calls. And what this does is it provides you a, we could say, a hedge for your risk, but also an opportunity to make some money on top of your long position. With the money you make, you can actually buy more stocks, right? So going back to buying calls, right? Whenever you're buying calls, you pay a premium. Who does that premium go to? Where it goes whoever's on the other side of that, right? So let's switch back onto the other side of it, where you're thinking of cover calls, or you think about selling calls. When you sell a call, whoever's on the other side of that buying that call is literally giving you that premium. How much they give you is determined by the price of that call option, which is determined by a lot of different factors that we talked about before, right? Premium, price, time, applied volatility, intrinsic versus extrinsic value, right? All the same factors that determine the price of a call's option when you're thinking about buying it are the same principles that determine the price of that same option when you think about selling it. It's just that when you're selling that call option, you're the one receiving that money, right? So let's go. Let's see if we can make this a little bit more clear. All right. Um, so risk, right? Now, what is a risk of selling a covered call, right? It's relatively low compared to buying calls, and that's because, let's say you have a, let's just go ahead and bring up a scenario. Covered calls. Let's say you have 100 shares of, somebody pick a stock, random stock, any stock. You can either unmute or throw it into the chat. Somebody pick a stock. Apple. All right, let's do it. All right, so let's see what the price of Apple is. Okay. So Apple's selling for about $167. Okay. Easy day. Apple $167 a share. Right. So if you have 100 shares, that means your position will be 167. All right, we'll move that decimal spot 2 places to the right. All right. All right. So if you own 100 shares of Apple, you own about $16,700 of Apple, right? That's your position size. So again, let's say over the long term, you think Apple is going up to like $300, right? Maybe even more. You're looking to hold it until retirement. So there's no telling how much Apple's going to be worth, how many stock splits they're going to have, but you're not looking to sell it, right? However, let's say there's elevated risk to your, all right, let's not just say risk. Let's say there's elevated risk or probability of stagnation over, so next 2 weeks, over next 3 months, right? Basically what that means is you foresee Apple potentially taking a dip over the next 3 months, or maybe just trading within a trading range. It's going up, going down, and going up and going down, but not really doing much. Or there's a probability of stagnation that's even that to extreme, where it's just Apple's really just trading flat, right? You're not really so much concerned because you're looking to hold it for the long term. However, if you can improve your position throughout this period of elevated risk or probability of stagnation, why not, right? So one of the things you could do, you're already not consider you're already not considering selling those 100 shares. So what if you can make money just from owning those 100 shares, right? And that although you're not interested in selling those 100 shares for the right price, you would be open to it. Let's say you considered selling a covered call, which essentially means, let's go ahead and just to make it a little bit more easy to understand. Oops. So you have 100 shares of Apple and you're considering selling a call. Well, what does that mean? Well, first, let's find an not expiration date. Let's find let's find an expiration date first. Let's go like April something. Let's find an expiration date, and now let's find a strike price. All right. So let's say, again, you think Apple's going to go up a lot, but over the next 3 months between now and April, it's 2 months, you think it's not going to go up much. It might even take a dip, or it might just stay flat. So you can sell a call, right? And whatever strike price you sell this call, what does it mean? Well, it means that whoever's on the other side of that, if they buy that call option from you and pay you that premium, they are buying the right to buy your 100 shares from you for whatever that strike price is that y'all agree to, right? So it's literally the same exact transaction that we were talking about before. However, you're on the other side of it, right? So where a buyer of a call is buying the right to buy 100 shares of something at a certain price, the seller of the call is selling someone the right for them to buy their 100 shares at a certain price. So in the event the buyer of the call exercises the right to buy your 100 shares from you at a certain price, you have to sell it to them for whatever price you agreed to in the beginning. And that's regardless of whatever price Apple is currently selling for. In if that makes sense, right? So they exercise it, you would give them your shares, they would pay you, and you would make that profit on top of whatever profit you received in the beginning when they paid you the premium for that right? Now, we talked about the possibility of the buyer exercising the right to buy your 100 shares. So they only have that right to exercise it if the price of Apple goes above the strike price you agreed to in the beginning, right? If the price of Apple never goes above that strike price and in fact goes down or just stagnates but never goes above, even if it's 1 cent below that strike price, they don't have the right to exercise that call that they bought from you, right? So in that event, you don't have to worry about giving anybody your shares. You keep your shares, right? And excuse me, you keep your profit that you received in the beginning of that transaction, right? Because think about it, when you buy a call, going back to the other side, when you buy a call, you pay that money up front, which means the person on the other side of that, when they enter that transaction with you, they receive that money up front, right? So let's say that, again, we have 100 shares of Apple, right? That's a position of about $16,700 because the price right now is at $167. And let's say that you consider selling a call at a strike price that is, we'll say, out of the money, right? We'll say 200. Yeah, do we want 200? Yeah, we do 200, right? Now you're gonna notice that the profits for this are of a lower percentage, right? So we'll end up talking about position sizing here shortly, right? Um, so we'll have the mark right here. We're gonna go here. We're gonna analyze selling. right? Oh, I gotta do some house cleaning. Clear some of this up. So 1 second. Gotta clear all of these old transactions. All right. So in this event, the scenario is we're selling a call option for a strike price of 195 actually, right? And you'll see that the price of the option is about $20. So what that means is you would receive $20 for this transaction, right? Very small amount, right? That would actually come out to so that would come out to like less than 1%, right? So it'd be a very small amount, right? And we'll talk about how you can do it in a way where this amount grows and how your position sizing can make it worthwhile. But in all the while, you have to remember that the real goal, if you're having these 100 shares, is to hold them for the long term, right? However, if you could benefit to some extent for holding these shares, or kind of hedge your bet, you want to do so. All right. So um, in this scenario, you have a strike price of 195. If between now and April, the strike price, the price of Apple goes above 195, the buyer of that contract has the right to buy your 100 shares for the price of 195 each. Right. And that's whether or not the price of Apple at that point is trading for $200, $300. So in that scenario, you might say, "Whoa, you're losing money," but not necessarily, right? Because if you had these Apple calls, these Apple shares, right, 100 of them, when Apple was selling for 167, and now you're selling your 100 shares to the buyer of your call option for $195 a share, you're still making money, right? Because where your 100 shares were first worth $16,700, your 100 shares would now be worth $19,500, which brings that to a profit of almost $3,000, right? So any money you made up front from the premium that the buyer of that call gave you would just go on top of the money that you're making from the appreciation of your shares. Anyway, right? So that's something to understand, right? Now, the reverse side of that, and this won't be too significant in this scenario because the premium is so low, but let's say that Apple went down, right? Or just stayed below, right? One, you wouldn't have to sell your shares, right? Whether or not you made profit on the appreciation or depreciation of shares depends on whether or not Apple shares depreciate or appreciate, right? But let's say it went down. Whatever you made from profit and premium, right? $20 for every contract you own. Essentially, that would offset whatever your loss would be. So, although it wouldn't be a lot in this scenario, right? Because you're only receiving $19 per contract, it could be a lot in other scenarios, right? And what those other scenarios are, right? Think about a more volatile stock, right? Something like we're going to use GME and AMC as an example, from back when they were crazy volatile, right? Um, I would tell you that if we were looking at a call option that expired in that expired 2 months out, right? I'll tell you that I guarantee the amount of money the seller of that call will be looking at here will be a lot more. And why is that? Well, because if we go back to implied volatility, we talked about implied volatility refers to the amount of an options premium attributed to a stock's perceived riskiness. To put it another way, it estimates how much price movement is expected by the market in that stock before expiration date. So I bring that up to illustrate why this wouldn't be as profitable. Like why they're only getting such a low amount of money for selling this call, and that's because the perceived probability of Apple trading for $195 by the 1st of April is relatively low compared to something that's more volatile, right? The more volatile something is, right? If we go back to our slide, the more volatile something is, right, the more inflated options contracts become. Because if a stock moves around so much that is very unpredictable, whoever is selling that call to you, they need to be compensated for the volatility or um, right of the risk of this stock moving around so much. It's less predictable, right? Like if there's a stock that makes $20, $30, $50 swings, like it's nothing, or back in it, like I think we were talking about AMC and GMC, you're talking about 100% swings back and forth. If I'm selling you a call that expires a few months out, I have to charge you way more because there's no telling what this stock is gonna do in the meantime, right? So I have to be compensated for that. So that's something to look into, right? Let's say you were looking to sell calls, covered calls. Um, Typically, those who are selling covered calls, if they're looking to take on more risk, right, hence more premium, they will look for higher volatility stocks. But the more you go down that route, the more you stray away from the strategy we're using in this scenario, which is someone who's just intends to hold these shares for a very long time. But if they can make a little bit more money, right, or offset the possibility of a little bit of a loss, then why not, right? All right, so let's go here. Okay, so far we talked about risk. We somewhat talked about position sizing. To go a little bit more in depth on position sizing, let's say we're dealing with we're dealing with this scenario where we're looking to sell a call for Amazon, a covered call for Amazon. I mean not Amazon, but for Apple. We saw that it's not very volatile, and that due to that lack of implied volatility, the premiums we will receive for that options contract will be relatively low, right? Well, when we say low, we're talking percentage wise. Let's say that percentage wise is like 1%. Well, looking at the relatively low risk in a transaction, someone with a very large portfolio may be interested in making 1% on $1 million. May be interested in making 1% on $10 million, maybe $100,000, right? Because stuff like that really adds up. If somebody can personally justify that risk versus reward, or lack there of risk and reward for that 1%, they may be interested in making that $10,000, $100,000, whatever that 1% is for their portfolio. That's how position size plays into it. Typically, when people are using covered calls, it's typically we kind of group that into an option strategy that's related to regular income, low profits but consistent profits. All right, so I would say that's how position sizing plays into covered calls. Um, Bullish versus bearish. Well, um, depending on the factors at play, somebody might sell calls because they're bullish but want to mitigate some risk. Some people might sell calls because they're a little bit bearish, but they also want to mitigate some risk. Um, it all depends, but typically, um, with scenarios like the one we discussed, that is someone who is bullish long term, but maybe they might be a little bearish leaning for the short term. We definitely talked about the buyer versus seller, because when it comes to selling cover calls, that's trading cover calls, you're literally selling the cover calls. We did not talk about in the money versus out of the money, right? So if we go back, not to this, but to this, we go to the options chain. We saw how much we get per contract for this strike price in this expiration date, about $20, all right? But let's see how things change as you go in more closer to the money, right? So at the money, we're talking about $500 in premium that the seller of this call would receive, right? And you go a little bit deeper and deeper. Strike price of 120, which is deep in the money. The seller of this call will receive about $4,700, about $4,800, right? Now, let's say that somebody wanted to do this, right? So essentially, they would have owned 100 shares of Apple at current price, about $16,700, right? And let's say that the price of Apple dropped, right? Let's say it dropped and dropped and dropped to about 120, right? Right where the strike price is. Well, obviously they would lose money in the 100 shares that they own, because now the 100 shares would only be worth about $12,000, whereas they were worth about $16,700 to begin with. But that loss of between $16,700 to $12,000, that loss would be offset by the profit of this premium that they received in the beginning, which would be $4,700. Right? Does that make sense? So, in a sense, let's say that Apple did drop this low. All right, let's say Apple did drop this low, but this person still was long-term bullish. Well, what might they do with that $4,700 that they received in the beginning? They might buy some more shares now that Apple is selling for $120 a share, right? So now they buy those shares of Apple at a discount with the premium that they received from selling the call in the first place, right? And then let's say Apple goes right back up to 167-ish. Now they not only make that $4,000 or so back that they had in unrealized losses, but they also flip that money that they received in premium uh, to more, because they would have bought about $5,000 in Apple shares at 120, and now Apple would be at 160, right? So there's many ways to trade cover calls. Um, the one I just described there is something that some call it's like a type of trading wheel, right? Where um, again, you were bullish long term, anticipated some volatility in the short term, sold calls to mitigate that risk, to potentially uh, make some money up front that you could use to buy Apple at a discount in the event Apple took a dip, as you were speculating it might, and then you make more money that way, right? But there's many ways. There's many ways to sell covered calls, but what we were just talking about was pretty much just in the money and out of money, like how the strike price being in the money, out of money affects the covered call that you're selling. All right. So one thing I want to do before cementing, well, in the hopes of cementing your guys' ability to grasp the concept of covered calls, is to discuss the opposite of covered calls, right? And antithesis of covered calls, right? And what that is, those are called naked calls, right? And let's see if we can go back to it. All right, because if you learn about covered calls, it's important to understand what the opposite concept is, right? So covered calls, we'll say covered calls versus naked calls. All right, so what is a covered call? Just a recap. When you're selling a covered call, you're selling someone the right for them to buy 100 shares of stock from you at a strike price that's determined at the beginning of the transaction. Right now, in the event that the buyer of the call has the opportunity and intends to exercise that call, they would essentially be exercising their right to buy your 100 shares for the price you determined in the beginning. Right? And then you would provide them the 100 shares. Right? Now, in a sense, you had that transaction covered. Because in the possibility, in the scenario that they wanted to buy the shares, you actually had the shares to give them, which means that transaction is covered. The worst case scenario is just, you have to sell your shares. Yeah, really, that's not the worst case scenario. Worst case scenario is the stock just going to zero and you being stuck in that transaction. But we won't go too in depth in there. Maybe in our next one. But again, if you sell a call, it's covered if you actually have 100 shares for every call that you're selling. Now, you might understand where I'm getting at. The opposite of that is if you're selling calls, right, on shares that you don't own. Now, the first thing you might be thinking is, well, why would somebody do that? Isn't that risky? And yes, you're absolutely right. All right, so I'll go ahead and I'll write this in. Naked, selling naked calls is one of the most riskiest forms of options trading. So, in fact, most of you aren't authorized to even sell naked calls. Um, whenever you open a brokerage account, they ask you a certain amount of questions, and depending on your answers to those certain questions, your income, your experience with options trading, stock trading, etc., they'll determine what level of options trading they will allow you on their platform, right? So selling naked calls is one of the most riskiest forms of options trading because if you're selling a call and then the buyer of that call chooses to exercise their right to buy 100 shares from you for every call you sold them, and you don't have 100 shares for every call you sold them, well, you better have the money to buy those 100 shares for every contract you sold them, right? Now, what makes this so risky is you have to buy those 100 shares at whatever the market's current price for those shares are, right? And as we know, when it comes to the stock market, there is no limit to how high a stock's value can appreciate, right? And if you're locked into one of these naked call transactions, for every dollar that the underlying stock goes up, that's more money you're losing because the higher that price is, the higher amount of money it's going to take you to buy as many shares as you need to buy in order to cover that transaction, right? Because if the buyer of the call has the right to buy 100 shares for every contract that you sold them, and you sold them 100 contracts, and the stock in question is something like Amazon, right? Well, now you're talking about you having to buy 1,000 shares of Amazon, which is already a lot. Now you throw into the scenario that Amazon just happened to have 40%, 50% appreciation over the course of whatever the time span of your transaction was, right? So now you're easily talking about hundreds of thousands of dollars, and depending on the price of Amazon, even more, right? So when it comes to selling naked calls, there is no limit to your potential losses, right? And that's very distinct from how many people trade options, because on the other side of it, when you're buying options, one of the things that makes buying options appealing is that your potential for loss is limited, right? When you're buying options, all you can lose. When you're buying like call options, all you can lose is what you put in. That's it. Whereas when you're buying call options, your profit potential is unlimited. So when you're buying options, your profit potential is unlimited, but your loss is limited. But when you're selling naked calls, your profit potential is limited and your loss potential is unlimited. Right? So it's a complete flip. People who sell naked calls are 100% of the times bearish, right? Because they do not want to be put in a position to have to provide 100 shares to the buyer for every contract that they sold them, right? Because then they would lose money. So naked calls are bearish. Covered calls are typically bullish, right? So a big difference between naked and covered calls is if you're selling naked calls, you don't own 100 shares for every contract you're selling. But if you're selling covered calls, you own 100 shares for every contract you're selling. So the lure of selling naked calls is that you could potentially make money for nothing, right? Because you'll literally be selling calls from which you receive premium up front without risking any money. I'm sorry, not to say you're not risking any money, but without putting any money up, you essentially be opening up your hands and hey, taking all this premium in, but you'll be putting yourself in a very risky position because in the event things go the other way, you would be obligated to buy shares so that you can give them to the buyer of your calls. All right, so I think we covered that enough. If you guys still have any questions about what a covered call is, what selling a covered call is, what the difference between selling covered calls and naked call is, um, what it means to be a buyer and seller of a call, how in the money versus out of money strikes affect a position, the position sizing, how that plays into the role, the risk, how that relates to other types of options, trading strategies. Um, please let us, please let me know now before we go on to the next topic. And you guys can either write in the chat or unmute your page. Lucid, somebody wrote Lucid. Sorry, Nick Cap. Matthew beat you. Beat you to the punch. All right, anybody got any questions about covered calls before we move on? Going once, going twice. Can everybody hear me? Awesome. Okay, so next we have, and again, a lot of you guys may be familiar with leaps, right? So when I think of leaps, I think of so when you're buying calls or selling calls, one of the first things you want to determine is what expiration date you want to uh, buy a call option or sell a. The first thing you gotta determine, and one of the first things you gotta determine is what you want your expiration date to be. All right. So when I think of leaps, I think of options with expiration dates that are further out. Right? So I'm thinking of something that may be 4 months out, 6 months out, 9 months out, 3 years out. There's no particular set point in order to define something as a leap. It just depends on you, but think of long-term options, right? Now, when people buy something that doesn't expire for a long time, doesn't necessarily mean they um, need to hold it for that amount. That they need to hold it for a long time. Sometimes, if somebody is putting in a very large amount of money into a position, right? They want to mitigate risk in the form of very different ways, right? And one thing to understand is that when something doesn't expire for a long time, the delta on that call option is going to be a lot lower than what something would if the expiration date was only a few days out, a few weeks out, right? And just as a recap, go back, talk about delta. Oops. We talked about delta here, right? Delta is Greek, responsible for measuring the amount an options contract's value appreciates or depreciates for every dollar the underlying stock increases or decreases, right? So for leaps, things that don't expire for a long time, the delta is typically much lower than it would be for a contract that expired within a short period of time, right? So the fluctuations would be more manageable um, and not as drastic as it would be for shorter contract. So essentially what I'm getting at, just to recap, people don't always buy long dated options or sell long dated options because they intend on holding them for that long. Um, Sometimes it's just a way to mitigate risk. You might think that Tesla is going up 10% over the next 7 days. You could buy an options contract that expires within 7 days, right? You could buy it in the money or out of the money, right? Different ways to mitigate risk. Let's say I want to buy in the money, right? But there'll still be some elevated risk there from the options contract being so short dated. Another way I could mitigate risk is I could buy it 2 months out, 3 months out, 2 years out, and that delta would go down. Um, and that would also be one way to mitigate risk, right? But you would still have that profit potential in there because let's say it does go up, the value of your contract would go up. All right, let's say the underlying stock shoots up a very significant amount, right? So much that the implied volatility of the stock goes up, and now the value of your leaps go up even more because now the perceived riskiness to the seller of the options has skyrocketed because now this stock is typically not as volatile has become very volatile. So uh, leaps, a lot of times you'll see me use leaps. It's sometimes it's because I do want to kind of set and forget, buy something and I don't have to worry about it, but worry about checking it all the time. But sometimes I buy them just as a way to still put myself in a position to make profits and possibly very significant profits, but also mitigate the risk of losing profits very quickly. Uh, Now that doesn't mean you can't lose money trading leaps. You definitely can. Um, However, uh, when you buy something very, very far out, it has more extrinsic value than something that expires soon, right? So every time you're buying a contract, right, it's made up of intrinsic value and extrinsic value. Sometimes it has no intrinsic value, right? But unless it's the day of expiration or after the day of expiration, it always has a level of extrinsic value. The further out you buy it, the more extrinsic value it has, the more time it has. So leaps, your question is, are leaps basically swings, right? So how do I answer this question? All right, so when you think of a swing, let me pull up a okay. All right. So when people use the term swing, they're not talking about the type of option, right? What they're talking about, if they're talking about swing trading, is they're talking about a method of trading options, right? So just like with anything, right? You can either there's a difference between investing and there's a difference between trading, right? Let's say you're investing. If you're investing, when I think of investing, I'm thinking more of putting my money into some form of asset and just allowing my money to appreciate with the appreciation of that asset, not checking it all the time to look for uh, opportunities to get out high and get back in low, right? Because that would be trading. No, I'm just say in this scenario, I'm just looking to invest, right? I'm just looking to store my money in a form of value that's different than cash, right? And there's many reasons to do that. And you can invest your money in all types of sort of things from stocks to NFTs to cryptocurrencies to cars to jewelry to houses. There's many different ways to invest, but when you're thinking about investing, you're not thinking about watching it every day, getting in and getting out. No, you're looking at something long term. To, a different form of storing your money, right? Whether it's gold, metals, all types of things. That's investing. Now, when we talk about trading, you are talking about getting in, getting out, getting in and getting out, making those profits from either swings or scalps or right. Because when it comes to difference between investing and trading, you also have different types of trading underneath that, right? And when you think of swing trading, typically you're thinking of something like this, all right? Because swing trading, it is very much, how can I say, hinged on someone's ability to predict movements in the stock that are shorter term than someone who is an investor. Someone who's an investor, they might just put in money every week to something, or even when it's down, they'll just put money in. Even when it's up, they'll put money in. They're not really trying to time the market. They're looking to put time into the market. But with trading, you're looking to time the market, and that takes a good understanding of technical analysis, which is essentially the ability to read charts, predict movements, predict probabilities, etc., and anticipate swings in the price. Right. So, say this is a swing low, then it swings high, swings low, swings high, swings high, and swings high, pull back. Right. Predicting these swings is a big part of swing trading. Right. You can make money on a swing up. You can make money on a swing down. You can make money if you think stock is just going to trade within a range, right? But you're talking about a type of trading, whereas you might hear something like scalping. You're looking into the very short term, um, and you're still kind of looking for swings, but we call them. So if I'm looking for a swing in a chart that's tracking 5-minute candlesticks, right? Each of these candlesticks representing 5 minutes worth of price action, right? If I'm looking for swings in and here, we don't really call them swings like swing trading. We call them scalps, because from here, from 170 to 171 is not a large, um, is not a large, it's not a significant price action, price movement, right? So you're talking about people who are scalping or just looking to get a piece of this intraday swing, right? From here to here, that might only be 1% gain if you're trading the stocks for. It might be a 5% gain if you're trading the options for. But they're getting in, they're getting out. They might hang in a little bit long right here, and then they get out because they anticipate a pullback, right? Or they anticipate that pullback, they might switch bearish, right? And start going short. And then that pullback comes in. All right, they get out. They get out. Now they start anticipating, you know, it to swing back up, and they get back in, right? So they're looking for small little pieces of this movement, and then just compounding those profits, right? So that's something like scalp trading. It's a type of trading. When you ask about swing trading, that's what it is. It's a type of trading. Swinging, scalping, day trading. Those are types of trading. So to answer your question on leaps, swings, I'll say no. There's hold on, somebody's gonna wait a minute. Right. Okay, I don't know how to move this thing. Oh, there we go. Okay, so to answer your question, are leaps same thing as swings? No, because swing trading is a type of trading, whereas leaps are a type of option. Right. So when I think of leaps, I'm thinking about an options I'm thinking of an options contract that has an expiration date that is far, far out. Now, how I choose to buy leaps, when I choose to buy leaps, right? It depends on how I want to, if I'm investing, if I'm trading, and if I'm trading, how I buy the leaps depends on what type of trading I'm doing. I could very well buy leaps as a part of my swing trading, or I can buy leaps as a part of my scalp trading, or I can buy leaps as a part of my day trading, right? Leaps are a type of option, whereas swing trading is a type of trading. I hope that answers your question. Let me see who that was. Check. Okay. Hey, Tay, does that answer? Oh, awesome, awesome, awesome. And again, this will be recorded. Sounds like you have to step out. So, but yeah, leaps, type of call option, or types of options, where swings are a type of trading. Let's get that. Anybody got any other questions that pertain to this? Oops, that pertain to this slide. What are leaps? Hold on. So far, we've gone over position sizing, I believe, right? Let's say I'm looking to go very big in my position. Many different ways to mitigate risk, and like we discussed earlier, one of those ways are to buy options with more extrinsic value, and we think of leaps when we think of options with a significant amount of extrinsic value. Um, so that's how that plays in position size and time horizon. I believe we've discussed that, right? Um, Again, we talked about trading. Let's say you're buying leaps as a form of investment. Then of course you want to go further out, a few years out, and you're not really looking to check it all the time. A lot of times, people might go back and forth with investing and trading, or they might have certain things that they invest in and certain things that they trade. Um, there are different ways to do it. Buyer versus seller, just how you want, in the same way you choose to buy an option that may be elite, you can also sell an option that may be elite. Whenever you're selling something, there's a buyer on the other side. Whenever you're buying something, there's a seller on the other side, right? The buyer's paying premium, the seller receiving premium. The amount of money there that's being transferred, right, relates to the value of that contract, and that value of that contract relates to many different things. One being the implied volatility, right? One being the extrinsic value, how much time is left to expiration, and one thing being the intrinsic value is the strike price, in the money or out of money, etc. All right. Calls versus puts. Again, same thing applies. You could buy a leap as a call. You could buy a leap as a put. You could sell a leap as a call. You could sell a leap as a put. Right? Any questions about leaps? And if not, we're going to open up the floor to general questions, um, whether or not they're advanced level or basic level questions. Once we move on from here, the floor will be open for questions across the board. So don't hesitate. Don't hesitate. Don't feel like, if you think you're asking a stupid question, please ask it, because there's no such thing as a stupid question. Stupid question is the question that you don't ask, right? So going once, going twice. Any questions about leaps? All right. So in that case, we're gonna go to. All right. We're gonna go to our Q&A. Right. Want to open up to the floor and give you guys a chance to ask any options related question that you have. I'm going to give you guys a good, at a very minimum, good 10 minutes, 15 minutes. Kind of bring up anything that you would like to get a better grasp and understanding of before you guys go back into the wild. Yes. Yeah. What? You want to introduce yourself? What's your name? Matthew. Matthew. Okay. How's it going, Matthew? What's your question? Yeah. 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 No problem at all, man. Okay. Let me see what it is. Do you remember whose trade it was? And I can try to. Yep. $116 put. Do you remember what the price was at that very moment? Because I could only speculate. Say it again. The, the price was at four. Oh, four. Right here. And the bot. Oh, this one. Okay. 116. Let's see. It probably was a scalp, right? Like a day trade, a very short. Okay. That was around. Oh, that was at the time. Okay, and this is the 18th. So 116 is down here. And what it was like around here, or at the time, or like around here. Okay, it's right here. Okay, so it was around like 117. Okay. Um. So they went. If they're buying puts, they're buying out of the money at that point, right? And it was selling for like what, $40, $40. So so they so I mean a lot of the guys who trade for for our Discord, like we use technical analysis, right? So we weigh the probability of certain things happening based on whatever we're seeing, right? And if somebody is day trading, it's no different. Sure, there's some differences in strategy, versus like swing trading, investing, right? But when you're doing day trading, the fluctuations they're more unpredictable than things that are further out, right? So, like when you're day trading, there's things that day traders do to, how can I say, uh, mitigate losses, but still take on risk, mitigate risk. A lot of that goes into like position management, position sizing, taking profits or whatnot. So why they alerted to that, at that point, I couldn't possibly, right? There's so much that goes into it, right? And a lot of that depends on, what they saw, what indicators they saw, what probability, they're pretty much predicting it would go even lower since it had gone as low as it did, right? Perhaps they saw like a level of support and it broke through it, and they placed the bet that, okay, if it goes even lower, it might go as low as this level or that level before it finds any buyers, right? Understanding there's a probability it might bounce there, but taking the bet that, all right, it's broken through this support. If it doesn't bounce back, it could potentially go that much lower, and having that 116 call at 40, might flip that, by 300%, so, I could only speculate, but it was out of the money, which means they definitely foresaw, it could have been like, I don't want to say it would have been like a lotto, because a lot of it times it depends. Like they could have made profit from here to here, right? Took profits and only put maybe like 10% back in right here, just for the off chance that it goes even lower. And if it bounces, they're still in profits because they only put 10% back into it. So I can only speculate again, but for trades like that, like for like the particular trader, um, you can always, just kind of ask for a little training, a little insight on the decisions. And I'm sure they always put in like I'm sure they put out like a stop loss in the chance that, it bounced like it did. But I imagine why they made that decision there was technically related, like related to technical analysis and risk versus reward. Sorry, I can't. Sorry that doesn't answer your question. Um, but I can only speculate. But I know that, like, I mean, those guys are great day traders. I wish I had the time because I work full time in the military. I wish I was in a situation where I could watch the stock market as much as I want to, but not get it. Those guys, those guys are good, but I can't really tell why they made the trade. Yeah, no problem. Anything else? Okay. All right. Well, thanks for asking that question. I'll give somebody else an opportunity before we wrap this up. Anybody? Man, I almost forgot. We don't have work tomorrow. It's great. Going once, going twice. All right. Well, everybody's free to go ahead and start exiting the meeting, unmuting their mics. Thanks for everybody that participated today. Um, yeah, I appreciate you. I appreciate the feedback. If there's anything we could do better, just don't hesitate to send some feedback, and we can make those changes in our next class. So look forward to next Sunday. You guys coming again. Awesome, awesome.